Welcome to Market Nerd, where seasoned analysts break down listed companies on the Philippine Stock Exchange. Don't forget to like, subscribe, and hit the bell to get the latest developments and investment ideas in the financial markets. Let's dive in.
Okay, so you send over the 2024 report, the annual report, I should say, for Philippine 7 Corporation PSC, and we're going to dig into it
Yeah.
and see, really what's changed financially for them this past year and kind of give you a good idea of what their outlook is, what they
Yeah.
see going forward.
It is pretty fascinating when you look at an annual report because it is almost like a detailed story about a company's past year and where they see things going.
Exactly.
So we're going to pull out the most important chapters of your story in 2024.
Exactly. And I think for our deep dive today, we're going to start kind of high level by looking at their balance sheet, comparing the end of 2024 to where they were in 2023 to see, what they own, what they owe, and what their overall equity position is. Then we'll move to the income statement to really see how their revenue and their expenses change, ultimately affecting their profitability. Then we'll look at the cash flow statement, and while the direct year-over-year comparison isn't as detailed in this report, we'll look at, the key cash flow movements that they highlighted. After that, we'll kind of dissect the risks and opportunities that PSC management themselves have identified. And finally, any forward-looking statements about the future.
Great.
So let's just jump right in, I guess, first to the balance sheet.
Okay. The balance sheet, as you know, kind of gives you that snapshot of a company's financial health at a specific point in time.
Yeah.
And by looking at the changes from 2023 to 2024, we can see how their assets, their liabilities, and their equity have changed.
Right. And looking on the asset side first, their cash and cash equivalents had a modest increase, 5%, about $529 million.
Okay.
So going from $10.56 billion roughly to $11.09 billion.
Yeah.
So it looks like they're a little bit more liquid now.
It does. But what's interesting to note is the short-term investments decreased by 100%. Going from $1.45 billion down to zero. Now, management clarifies that these investments matured within 90 days and were then reclassified under cash and cash equivalents.
Okay.
So it's more of a change in classification than a significant depletion of readily available funds.
That makes sense. Okay. And now this is something that really kind of jumps out, is that their property and equipment increased significantly, 21.5%.
Wow.
And the report explicitly links this to them opening 399 new stores in 2024.
So that's a lot of stores.
Yeah, so their total assets also rose a healthy 9.5%, or $3.75 billion, so reaching $43.28 billion. So clearly, the asset growth is tied to them expanding and building out more stores.
That's a significant investment in growth for sure.
Yeah, it really is. And then looking over on the liability side of the balance sheet, accounts payable increased by 26.5%, and other current liabilities also increased by 19.3%. So what's the story there?
So this is where management's notes come into play. They've attributed these increases to the timing of longer non-banking days at the end of 2024.
Okay.
Essentially, there were some payments that would have usually been processed before year-end were delayed, making the liabilities appear higher on the books as of December 31st.
Okay.
So it seemed to be like a temporary blip due to timing rather than a fundamental issue with their payment obligations.
Okay.
And as a result, their total liabilities also saw a significant increase, 26.9%, or $7.25 billion, reaching $34.21 billion.
Okay, so that timing explanation is good to know, because otherwise, that could be a little alarming, but, it sounds like more of a timing issue.
Right.
Okay, and then moving on to equity.
Okay.
Common stock doubled.
Wow.
100% increase from $757.1 million to $1.51 billion. I think this has to do with a stock dividend, I recall reading.
You are exactly right. The doubling reflects the 100% stock dividend that they distributed in 2024. A stock dividend is when they increase the number of shares you hold, but it doesn't actually change the company's underlying assets or liabilities.
Right.
It's like cutting a pizza into more slices.
Right.
The total amount of pizza stays the same.
Okay, yeah, so it's not a big change in terms of the underlying economics of the business.
Right.
And retained earnings, both appropriated and unappropriated portions, decreased.
Yes. Appropriated retained earnings decreased from $8.8 billion to $5.65 billion, and unappropriated retained earnings fell from $2.71 billion to $1.65 billion. The report highlights that this was driven by a substantial cash dividend payment of $7.26 billion.
Oh, wow.
And when a company pays out cash dividends, it directly reduces its retained earnings.
Okay.
The stock dividend also plays a role as it involved a transfer of some retained earnings to the common stock account.
Okay, that makes sense. And there was also a notable shift in other comprehensive income, moving from a gain of $17 million to a loss of $32 million.
Yeah,
A pretty big swing.
indeed. Now, other comprehensive income is kind of a catch-all term for certain gains and losses that aren't included in the regular net income calculation.
Okay.
These can include things like unrealized gains or losses on certain investments or changes due to currency fluctuations. The fact that it swung from a gain to a significant loss suggests some headwinds in these specific areas for PSC in 2024,
Right.
something to potentially dig deeper into
Right.
if you have access to the full notes of the financial statements.
Got it. So looking at the big picture, the total equity decreased substantially, 27.8% or $3.5 billion, ending up at $9.08 billion. It seems this big decrease is largely due to that big cash dividend payout and the accounting impact of the stock dividend.
Precisely. While their assets grew, the decision to distribute a big portion of their retained earnings through dividends led to a contraction in their overall equity.
Okay.
So you might want to think about their strategy here, investing in growth, but also significantly rewarding shareholders.
Gotcha. Okay, let's move to the income statement and see how their profitability changed between 2023 and 2024. We also have some comparative figures going back to 2022,
Okay.
which I think give us a little bit better sense of their performance trends.
Right. The income statement tells you how profitable a company has been over a specific period.
Yeah.
And looking at these year-over-year changes can reveal important trends in their revenue generation and cost management.
Exactly. So revenue from merchandise sales increased by 24.6% from 2022 to 2023, and then by another 13.9% from 2023 to 2024,
Nice.
totaling a $7.06 billion increase.
Wow.
So the report credits this to a 3.2% same-store sales growth for the full year and a 9.6% rise in the number of operating stores. So both, established stores and new stores contributed to this revenue growth.
That's a really good sign that both the existing business is healthy and they're able to expand and reach a broader market. You might want to keep track of whether the same store sales growth is sustainable as they add more stores.
Right. Yeah, that's a good point. Of course, with higher sales, we'd expect higher cost of sales.
Right.
So cost of merchandise sales increased by 24.3% from 2022 to 2023, and then by 14.6% in 2024, which was a $2.85 billion increase.
Okay.
They mentioned higher volume, which you'd expect, but also additional discounts and rebates.
So the fact that the increase in cost of merchandise sales is broadly in line with revenue growth is generally what you would expect. The mention of increased discounts and rebates could be part of their competitive strategy or efforts to drive volume.
Right.
It would be interesting to see if this trend impacts their gross profit margin over time.
Right. Good point. And speaking of gross profit, that also increased by 25.6% from 2022 to 2023, and by 14.6% in 2024, which was a $2.85 billion increase. What's interesting here is that their overall gross profit margin relative to revenue from contracts actually improved slightly from 26.9% in 2023 to 27.1% in 2024,
Interesting.
which they attribute to a higher merchandise sales contribution. So it seems like things are, moving in the right direction there.
Yeah, a slight improvement in gross profit margin suggests that they're managing their cost of goods sold effectively, even with increased sales and some discounting. And the higher contribution from merchandise sales, which likely have healthier margins than some other revenue streams, is definitely a positive indicator.
Okay, good. And then we saw franchise revenue and service income also increased by 23.7% from 2022 to 2023, and by 14.3% in 2024, which is a $3.15 billion increase.
Wow.
And this, they say, is attributed to having more new franchisees, although they did note that the contribution from service income actually decreased as a percentage of sales.
So the growth in franchise revenue really is a direct reflection of their expansion efforts as more franchise outlets come online.
Right.
The fact that service income contracted as a percentage of sales is something that you might want to look at more closely in the full report if you have access to it.
Okay.
It could indicate a shift in their revenue mix or some changes in their service offerings.
Gotcha. General and administrative expenses also increased by 19.6% from 2022 to 2023, and then by 14.3% in 2024, which was a $3.15 billion increase. But the report highlights that the rate of expense growth actually slowed down due to what they call the positive impact of operating leverage.
Right.
Yeah.
That's an important point. While their expenses are growing as the business expands, the fact that the growth rate is slowing suggests they're becoming more efficient in managing these costs as they scale up. Operating leverage essentially means that their fixed costs are being spread across a larger revenue base, leading to lower per unit costs.
Yeah, that makes sense.
Yeah.
And then looking at interest income, saw a massive jump, 443% in 2024,
Wow.
increasing by $385 million, from $87 million to $472 million. This is attributed to higher interest income from short-term investments in 2023. But if you recall, we just saw that short-term investments decreased significantly in 2024. So I wonder if this big income number is a result of investments that they held in 2023 that maybe generated returns in early 2024 before maturing.
That's a very astute observation. It's possible that the substantial interest income in 2024 is a result of returns realized on those investments held during the previous year before those investments matured and were reclassified. The timing of investment cycles can sometimes lead to these discrepancies in year-over-year comparisons of specific income items.
Okay, that makes sense. And on the other hand, interest expense also increased by 6.3% in 2023, and then by 9.8% in 2024, reaching $957 million. The main driver here appears to be a 12.7% rise in interest on lease liabilities, which they say reflects a 12.8% increase in their lease agreements for their growing number of stores and facilities. However, the report mentions that their outstanding loan balance decreased significantly by 59%, with only $70 million outstanding at the end of 2024 because they used strong cash flow to pay off debt. So that's a huge, reduction in their debt.
Yeah, the increase in interest expense related to leases is a direct consequence of the expansion efforts and the accounting treatment under IFRS 16, which requires companies to recognize these liabilities on their balance sheets.
Right.
However, the substantial reduction in the outstanding loan balance is very positive. It shows improved financial health and reduces their vulnerability to interest rate fluctuations on borrowed funds. The fact that they use strong operating cash flow to achieve this really speaks volumes about the underlying profitability of their operations.
Yeah, that's a good point. So all of these changes ultimately led to a significant increase in net income, which jumped by 69.3% or $1.43 billion from $2.06 billion to $3.48 billion.
Yeah.
And this growth, they say, is attributed to higher total sales driven by both same-store sales growth and an increase in the number of stores. So it looks like their growth strategy is impacting their bottom line.
Absolutely. That substantial increase in net income shows that their revenue growth is exceeding their expense growth.
Yeah.
And their efforts to manage costs and reduce debt are contributing directly to their improved profitability.
Okay, great. Now let's move on to the cash flow statement.
Okay.
And while this report doesn't provide a direct year-over-year comparison that's, as detailed as the balance sheet and income statement, there are some important highlights for 2024 that we should look at.
That's right. Even without a full comparative breakdown, the information they provide on their cash flows gives us some valuable insights into how they're managing their money.
Exactly. So we know that operating cash flow improved by 8.7% in 2024, reaching $13 billion. So that's a lot of cash being generated from their core day-to-day business activities.
An improvement in operating cash flow is always a good thing to see. It indicates that their primary business operations are more efficient in generating cash, which can then be used for things like reinvestment, debt reduction, and returning value to shareholders.
Right, and as we mentioned before, the report says that they use this strong cash flow to pay off a large amount of their debt.
Right.
Which led to that huge reduction in their outstanding loan balance.
This is key. Prioritizing debt repayment with their strong operating cash flow shows a disciplined and prudent approach to financial management.
Exactly.
Ultimately strengthening their financial position.
And finally, it's consistent with what we saw on the balance sheet. Their cash and cash equivalents increased over the year, highlighting that strong liquidity position.
Exactly. The combination of increasing cash reserves and reducing debt really paints a picture of a financially sound company with strong cash-generating capabilities.
Right. Okay, now let's look at some of the risks that the management of PSC have highlighted.
Okay. Understanding the risks that management identifies is crucial because it shows you what they perceive as the potential challenges
Right.
and where they are focusing their efforts to mitigate the negative impacts.
So in terms of just like industry-wide risks, they pointed to increased competition, which is maybe not surprising in the convenience store space.
Right.
They also mentioned brand reputation, which is always important for a consumer-facing business.
Of course.
And finally, they highlighted business operations and supply chain continuity, which has become a much bigger area of focus, in recent years.
Yeah, those are definitely some of the key risks that are inherent in the retail industry. Increased competition can squeeze margins and impact market share. Brand reputation is essential for customer loyalty. And as we've seen recently, any disruptions to their operations or supply chain could directly affect their ability to serve customers and maintain profitability.
Exactly. And they also identified financial instrument risks, particularly credit risk, liquidity risk, interest rate risk, and foreign exchange risk.
Yeah.
And we've already talked about how they've reduced their interest rate risk by paying down debt, but what about the other risks?
Right. These are standard financial risks that most companies face. Credit risk is the possibility that customers or other parties might not meet their financial obligations.
Right.
Liquidity risk, as we've noted, appears to be well managed given their healthy cash position and access to credit facilities.
Right.
And while their interest rate risk has decreased, it's still there on the remaining debt and those lease liabilities.
Okay.
Foreign exchange risk would primarily be a concern if they had significant transactions or holdings in currencies other than the Philippine peso.
Okay, good to know. The report also mentions the lingering impacts of the COVID pandemic, noting that it required them to reassess their market development plan, with a stronger emphasis on boosting sales and profitability.
Right.
Additionally, they mentioned that unfavorable weather conditions caused some delays in their construction timelines for new stores, which, I guess kind of goes with what we were talking about before in terms of the pace of their new store openings.
Yeah, the pandemic has had some lasting repercussions for many businesses, and it's important to see how PSC has adapted its strategies in response. Weather-related disruptions are also a challenge for companies with physical expansion plans
Right.
and can certainly impact timelines.
And then finally, they specifically called out customer privacy as a significant risk, particularly concerning unauthorized access and disclosure of personal information. They mentioned they're making efforts to enhance their access control policies, conducting regular security reviews, and utilizing third-party security providers for vulnerability and penetration testing.
Data privacy is a paramount concern for any company that handles customer data. It's reassuring that PSC is proactively addressing this through security measures and by committing to the principle of privacy by design,
Right.
which aims to build privacy safeguards into their systems from the outset.
Okay, great. So those are the key risks. And now let's look at the opportunities that PSC's management believes are out there for them to capitalize on.
Okay. Identifying and capitalizing on opportunities is key for any company's growth and success.
Right.
And management's perspective gives us insight into their priorities and where they see potential.
So a major opportunity they highlighted is store expansion. Their medium-term goal is to reach 5,000 stores by the end of 2026.
Wow.
And they're targeting 400 to 500 new store openings annually.
That's ambitious.
I know, with over 200 already in the pipeline. They also noted that store openings outside Metro Manila have accelerated. So there's a broadening geographic strategy here.
This plan clearly shows their confidence in the market and their ability to grow their presence.
Right.
And their increased focus on areas outside the capital could tap into new customer segments and potentially less saturated markets.
Right. And another area of opportunity is enhancing their offerings.
Okay.
So they're continually introducing new items, including fresh produce salads, ready-to-eat meals, more snacks, and premium coffee. They specifically mentioned new Japanese and Korean-inspired snacks, premium curry meals under their Chef Creations line, and premium toasted sandwiches.
Those sound really good.
They've even partnered with Romantic Bay Boy Restaurant to feature Korean meals, and they've expanded their healthier options like shake salads and fruit cups. So
Yeah.
it sounds like they're catering to a variety of tastes and preferences.
It sounds like they're really in tune with what people want.
Yeah.
This constant focus on innovation is vital for staying competitive and keeping customers happy.
Sure.
The partnerships and the introduction of diverse and healthy options shows they're responding to changing consumer trends.
Exactly. They also highlighted their 7 Connect platform, which facilitates cash payments for bills, tickets, and e-commerce. And that seems like a valuable service in a market where cash is still a big way to pay.
Right. Platforms like 7 Connect can really enhance the convenience factor of their stores and attract a wider customer base, particularly those who rely on those cash transactions.
Right. And their own branded products and services like Big Time Meals, Hatalam, and their CLIQQ loyalty program are also seen as a key opportunity. It seems they're actively developing these in-house brands.
Developing strong own brand products can improve profit margins and foster customer loyalty.
Yeah.
The CLIQQ loyalty program is also a valuable tool for building customer relationships and gathering data on consumer preferences.
Yeah, that's a good point. Then they also talked about the expansion of cash recycler ATMs through their collaboration with SEVN Bank, which not only improves the efficiency of cash handling, but also generates fee income.
So for a business with a significant volume of cash transactions, efficient cash management is really important.
Yeah.
These ATMs streamline operations and also provide an additional revenue stream.
Right? Sustainability initiatives are also presented as an opportunity. They're exploring more sustainable alternatives to plastic,
Okay.
expanding their network of suppliers for wooden cutlery recycling, used cooking oil into biodiesel, installing solar energy systems in some stores, participating in Earth Hour, and complying with the Extended Producer Responsibility EPR Act.
It's really good to see this focus on environmental responsibility.
Yeah, it seems like they're taking that pretty seriously.
Increasingly, consumers are valuing sustainability, so these initiatives can boost their image and potentially lead to cost savings in the long run.
Right.
Adhering to regulations like the EPR Act is also essential.
They also mentioned energy-saving cost initiatives like their off-peak project with a utility provider and exploring solar power. So these efforts not only benefit the environment, but can also lead to lower operating expenses.
Yeah, energy efficiency initiatives are a win-win situation. They lower costs and align with sustainability goals.
And of course, maintaining high customer satisfaction is seen as a major opportunity,
Right.
as it can lead to repeat business and strong sales. So their ongoing efforts to improve their in-house brands, product offerings, and customer service reflects that focus.
At the end of the day, a satisfied customer base is the foundation of a successful retail business. Their commitment to feedback and improving is key.
And lastly, their data privacy management program is an opportunity to build trust with their customers by adhering to those privacy principles.
Right. In an era of data breaches and privacy concerns, a strong data privacy program can build trust and confidence.
Right. So they're pursuing a lot of different opportunities, from expanding their core business to innovating their offerings to improving operations and being, a responsible business.
Their outlook seems really comprehensive, addressing both immediate growth and long-term sustainability.
Finally, let's look at the forward guidance that PSE's management has provided regarding their future revenue and earnings.
Okay. Forward guidance is a glimpse into their expectations and priorities.
Exactly. So they're still targeting those 400 to 500 new stores annually, supported by what they say is a more favorable economic outlook. So it shows a continued strong commitment to that expansion of their stores.
This really underscores their confidence in the growth potential of that market in the Philippines.
Right. They're also saying that their strategic market development plan will continue to take into account evolving consumer preferences for things like innovation proximity and convenience. So this suggests that they're going to stay on top of things and try to meet those changing customer needs.
This customer-centric approach will likely be a key driver of their success in such a competitive landscape.
Right, and they've reaffirmed their goal of operating 5,000 stores before the end of 2026.
Wow.
So that gives us something to watch for to see how they're doing.
Right, that specific target allows everyone to see how their growth strategy is playing out.
Exactly. And maybe most notably, they've approved an appropriation of $1.5 billion from their unappropriated retained earnings to improve and upgrade their warehouses and systems in 2025.
That's significant.
Yeah, so this clearly shows that they're planning on investing in their infrastructure to support those expanding operations.
Investing in their warehousing and logistics like this indicates that they're anticipating that growth and taking steps to ensure their supply chain can handle it.
Right.
It shows a commitment to efficiency and scalability.
So all of this forward guidance aligns with, what we've seen in terms of their recent performance. The opportunities they've identified was a strong emphasis on continued store expansion, and then the necessary infrastructure investments to support that.
Their forward-looking statements are consistent with the trends and strategies that we've observed.
So there you have it, a deep dive into PSE's 2024 annual report.
Yeah.
We've seen a lot of changes in their balance sheet reflecting both asset growth and the impact of those dividend payments.
It paints a picture of a company that's in a growth phase, and they're becoming more profitable and rewarding their shareholders.
Their income statement showed strong revenue growth.
Right.
And of course, increasing expenses, but ultimately leading to a big increase in net income. And while we didn't have that full detailed cash flow comparison, we saw that strong operating cash flow was being used to pay down debt.
Management seems to be proactively identifying and addressing risks.
Yeah.
And they clearly lay out opportunities, which gives us valuable context for their strategic direction.
It's also interesting that they acknowledge industry-wide and financial risks, but they're actively pursuing opportunities for growth and innovation, particularly through their store expansion and their evolving products.
Right.
Their commitment to those sustainability initiatives also signals a forward-thinking approach.
Absolutely.
And that specific guidance on store openings gives us a metric to watch in the coming years.
And those investments in the warehouse infrastructure shows they understand that they need a strong foundation for that growth.
Exactly. So this should give you a good understanding of PSE's recent financial performance and their future direction, as outlined in their annual report. So what stands out to you most from these changes and what management's saying?
This deep dive raises a question. How will they navigate the risks of expansion while staying profitable and adapting to what Filipino consumers want?
Right. It's definitely a dynamic situation.
Yeah.
And I think there are a lot more layers that we could explore here. Perhaps in our next deep dive, we could look at how they're positioned against competitors, or even take a closer look at their store expansion strategy.
Sounds good.
So let us know what you're most interested in learning about.
Liked what you heard? Drop a comment, like, and share this episode. Hit subscribe and tap the notification bell. We've got more insightful market ideas coming your way. Catch you on the next one.